All right, good morning. It is December 11th, 2025. What we saw today was a major fracture in the market narrative, a day that I think is going to be remembered as the beginning of the great AI re-rating. Let's get straight into it.
So this is the big question on every single institutional desk this morning. Is the bubble popping, or is the money just moving somewhere else? The data is telling us we are not seeing a collapse. What we are seeing is a violent rotation of capital, and figuring out where that capital's going, well, that's the most critical variable right now.
The main signal from today's session was one of, really, an extreme divergence. The market isn't a monolith anymore, it has split, and it's split decisively into two completely separate and conflicting stories.
Okay, let's just look at the numbers here, because this chart tells the whole story. You've got the Dow Jones, think of it as a proxy for the real physical economy, hitting a new all-time high. Then, in complete contrast, the tech-heavy Nasdaq fell. Now, this isn't just random market noise. No, this is a clear, unmistakable signal that capital is fleeing speculation and it's looking for a safe harbor and tangible value.
So the key point here is that for the better part of a year, the whole AI thesis basically lifted all boats. That correlation, it's now completely broken. What we have is a crisis of confidence in one part of the market, while another part is absolutely thriving. And the whole thing is being driven by a huge macroeconomic catalyst.
And that catalyst, of course, is the Federal Reserve. Yesterday's policy decision was really the thing that forced the market to completely recalibrate its expectations for the future, and it had immediate, painful consequences for tech valuations.
Look, the 25 basis point rate cut, that was expected. Everyone had already priced it in. The real story, the catch, was hidden away in the Fed's Summary of Economic Projections, and specifically in that document we all know as the dot plot. And you know, the power of a single number here is just striking. The market was pricing in 2, maybe even 3 rate cuts for 2026. The Fed just came out and signaled only 1. This effectively pulls the rug out from under that whole cheap money forever idea. It reinforces a higher for longer interest rate world, which, let's be clear, is absolute poison for long-duration growth assets.
In Chair Powell's own words, just hammer this point home. He's signaling patience. There's no rush to cut rates any further. This whole data-dependent stance puts a hard ceiling on the valuations for tech companies, the ones that depend on earnings way out in the future, which get discounted much more heavily when rates are high. So let's move on and see how this feeds into the first part of our AI story today, the thesis. And the thesis is that the hardware build-out is facing a very, very severe reality check. And the catalyst for all this? Oracle.
Now, on the surface, you look at Oracle's results, they looked pretty solid. 14% year-over-year revenue growth in this economy, that's not something to sneeze at. But the market is always looking forward, not backward.
And what the market saw sent the stock plummeting 14%. A violent reaction like that tells you the disappointment wasn't just about some minor revenue miss. No, this was a fundamental break in the entire investment thesis.
The reason for that break is this concept we're starting to call CapEx indigestion. For months, the playbook was just dead simple. Go out and buy billions of dollars in Nvidia chips. But Oracle's results just showed that the return on that massive capital expenditure is slowing down. So the market is now absolutely terrified that we've built the infrastructure way, way faster than we can actually make money from it.
And make no mistake, this wasn't just an Oracle problem. The fear spread. Oracle's weakness kicked off a contagion effect across the whole semiconductor sector. Nvidia, Broadcom, they all sold off. What this is telling us is that the blank check era for AI hardware is probably over.
But right as that hardware thesis started to fall apart, a really powerful counter-narrative emerged. This is the antithesis, and the idea is that capital isn't actually leaving AI. It's just rotating to a completely different part of the tech stack, the application layer.
And the catalyst for this story was Disney's landmark $1 billion investment in OpenAI. But look, this isn't just about the money. This is a massive strategic partnership to license its incredibly valuable intellectual property. We're talking over 200 iconic characters directly into OpenAI's video generation models.
So this brings us right to the heart of the conflict today. The old play, which Oracle represents, was all about massive spending on infrastructure with returns that are now, well, questionable. The new play, pioneered by Disney, is about using proprietary data and IP on top of that infrastructure to create completely new ways to make money. This right here, this is the re-rating in action.
So, what does this all mean for strategy? Where do we go from here?
Let's try to bring all these threads together and figure out how to navigate this new fractured market landscape.
First off, we have to admit that the background risks are on the rise. A tanker seizure near Venezuela, new reports about trade bifurcation, all of this is adding a risk premium to energy, and it's introducing structural inflation. This kind of environment really favors caution and a focus on high-quality assets.
The Fed's hawkish stance is also creating headwinds for other risk assets. You can see it with Bitcoin. It's really struggling to clear that psychological 100K barrier as liquidity tightens up. But, and this is a crucial but, the underlying institutional ETF inflows are still positive. That suggests there's a structural bit under the surface, even with all this macro pressure. So if there's one thing to take away from today, it's this. This is not the end of the AI theme. It is, however, the end of the dumb AI theme. The market is finally getting smarter. It's getting more discerning. It's now making a distinction between the capital-intensive builders and the capital-light owners of intellectual property.
This great re-rating is happening right now. The days of indiscriminate buying are over, and the era of actual stock picking has returned. So the critical question for every single investor tonight is pretty simple. On which side of this great divergence will your capital be?
Please note, this content is for educational purposes only and is not financial advice. All investment decisions should be made based on your own research.